Welcome one and all. In today's discourse, we will delve into the spectrum of employee retention tax credits. This formidable financial provision can directly influence a company's fiscal health while offering a critical incentive in the preservation of jobs. Across America today, enterprises large and small are tapping into this avenue to shore up their financial resources. But how does it work? And what is its significance? Let's begin our journey. The Employee Retention Tax Credit is a government-provided tax benefit designed to encourage employers to keep employees on their payroll despite experiencing financial hardship due to the COVID-19 pandemic. It was created under the Coronavirus Aid, Relief and Economic Security Act, the CARES Act. However, it's not just a relief mechanism, it is a growth enabler which can fuel growth ambitions for businesses. The financial benefits of this tax credit can be significant. It applies to qualified wages and health plan expenses paid after March 12, 2020, and can provide a substantial reduction in employment tax liability for eligible businesses. But how does taking advantage of this credit impact your bottom line? Just imagine, as an SME owner, this could be the pot of gold you need to stabilize and scale up your business during these challenging times. As we close today's discussion, it becomes clear that understanding the Employee Retention Tax Credit can be a vital financial strategy for businesses in trying times. This credit not only assists in stabilizing financials but could pave the way for growth and expansion. While it is essential to navigate the legalese with a tax advisor or an accountant, the benefits can far outweigh the effort. Remember, knowledge is power.